All right, welcome to Asked and Answer. That's what I'm calling this training. And so basically this is how it works. If you spend any amount of time trying to learn how to be a better trader or an investor, you quickly realize that there is a lot of information out there about the subject. Everybody's got an opinion, and everybody, it seems, wants you to give them their money or your money, right? Unfortunately, it is very difficult to determine who actually knows their stuff and who is just a bunch of hot air. And haven't you noticed that there are hundreds of websites out there promising to teach you how to be rich if you just buy their course? Thousands of videos online about the most amazing trading system that always wins, and just as many experts with books, courses, seminars, memberships, newsletters, and anything else that they can sell. Now the truth is that sadly the majority of these folks couldn't trade their way out of a paper bag, and that is why you do not see many of them last for more than a couple years. At Option Genius, we've been, knock on wood, we've been around since 2009, and we only get stronger every year. And that is because we actually trade. What a concept, right? We do what we teach, and we want to make a difference instead of just getting into your pocket. So because of this, we have developed a reputation for honesty in the industry. And so we get several questions emailed to us every day about all different topics. Now, as head trader of Option Genius, I believe it's my job to best direct those looking for guidance because I know what it's like to be in that shoes, when you're a new person looking for direction and trying to make it work. I've been there. I know what it is. So I always want to be able to spend some time every day helping as many people as I can. So I do my best to answer each one. Now some emails just require a line or two of text. It's not a big deal. It's a simple question. Some of them need a lot more explanation, so I do direct them to a blog post or an article that we have or maybe a video that we've done for more information. And then there are those questions which would require a book to answer them. Now, most questions are asked again and again. So I decided to pull back the curtains, share the truth, and give you unfettered access. Now, this is the stuff trading gurus only share after charging you tens of thousands of dollars to join their inner circle of their coaching program. Now, I'm holding nothing back here. You're going to get all the answers, the good and the bad. So a lot of these answers, you might not like the answer, but I'm going to give you from my experience. Now, keep in mind that I am not a financial advisor. I am not offering individual investment advice, and I am also only one person. I have my tendencies, my biases, my quirks. All the answers presented in this training are my own opinions based on my experiences, my trading history, and what I've seen from others in the industry. Okay? The answers reflect my thinking as of the date of the recording. And since I'm constantly learning new things and the markets do change, my answers might change in the future as well. Now, every one of the following question that we're going to be covering has been asked by a real trader. We have not changed the grammar, the spelling, or the text of the question. So you'll see that some of the questions, there might be missing a comma or there may be a little bit not clear as well. But we've taken basically cut and pasted all the questions. We didn't want to change anything to clean it up. All right. So let's go ahead and get started. The first section we're going to be talking about is beginner questions. So here's our wonderful disclaimer. Of course, trading is risky. Do not trade with money you can risk or you cannot afford to lose. We're not financial planners or advisors. Okay? All right, so here's the first question. If I sell a 45 September call at expirations, what happens if the stock is trading at $40 or if the stock is trading at $50? So basically this is a naked 45 September call. If you're selling a call, you want the stock to stay below your strike price, so you want it below 45. So if the stock is trading at $40, your call expires, you keep the premium that you got, and it's a successful trade. If the stock is trading at $50, which is above $5 above your short call, you're probably going to get exercised. You will have to provide 100 shares to your broker, so you lose the $500 because it's a 5-point difference minus the premium that you collected, so you don't lose the whole 500. You did get the credit, so the credit is yours to keep minus the 500. That would be your loss. Now, in this case, since it's that deep in the money, and if you let it go to expiration, you will be having to give up those shares. And so on Monday, that position will be in your account. It could move in your favor on Monday. It could move against you. So your loss might increase or decrease depending. At that point, you will have to go into your account. If you don't want that position, then you have to get out of those shares. Your broker will probably be sending you an email probably the day before expiration that, hey, you got something that you have an option that's expiring, and then on Friday or over the weekend they'll send you an email saying that, hey, you have been exercised, and so you should know that as well. Cool. All right. Question number 2, can you tell me in real life how do options work? Yeah, this is one of those book questions. I have read many articles. However, in reality, I'm still trying to figure out how it works on a daily basis. Can I practice it on a website or other sources with the alerts you provide? So the question here, it's obviously there. It's, you need a book to figure it out. We spend a lot of time teaching about this stuff. We have a lot of stuff on our website that covers this. There is a free course that we have at optionincome.net. You just put your name and email and you get those lessons. You can also, which is really big, I tell everybody this, you open a trading account at your favorite broker and you paper trade for free. You do as many trades as you can. You do it for as long as you want. Get a lot of trades so you understand how the trades actually work. Now, if you're an Option Genius member, we have something called the Paper Trading Workbook, which I think is awesome. And if you're new to options especially, you should be going through that workbook step by step by step, and you'll master, maybe not master, but you'll have a great idea of how every single strategy works, coming from simple puts and calls all the way up to complicated iron condors, butterflies, calendars, and all that. So if you're a member, you need to download that and go through it. Why do option sellers like to boast that 70-80% of options expire worthless? It seems to me that whatever way the underlying moves, the sum of puts and calls that expire worthless should stay the same. So if it goes up, you have more worthless puts. If it goes down, you have more worthless calls, but the sum would stay the same. So only 50% expire worthless and 50% don't. Okay, so this 70 to 80% options expiring worthless, that comes from a study that was done several years ago by, I forgot his name, but he was a researcher. He went to the CBOE and he said, give me all your data on all of the options on the SPX for several years. And he analyzed all of them, he counted them all up, and based on his research, he found that about 80% of options do expire worthless. Now, it makes sense if, the question is saying 50-50 should expire, but that is assuming that there are an equal number of puts and calls. That doesn't have to be the case. It depends on what people want to be trading. So at any given time, there could be 5 calls being traded, and there could be like 5,000 puts being traded. That's a really extreme example, but it is possible. It doesn't have to be 1,000 puts being traded and 1,000 calls. So it doesn't have to be 50-50%. In fact, it probably would not be 50-50% because if something is trending, for example, most of the options and the bets would be placed on one direction or another. We do have a explanation of this that goes into more of the it actually goes into the data that the guy came up with. It's on our website if you want to write down that very long URL and you can read his exact research. You can read about how he came about all that information and his hypothesis and how he came up with that 75 to 80% number. Cool. Let's go. What do you consider the 3 best option spreads for newbies, and what are the specific market conditions that are more favorable to each? All right. Well, for this answer, I'm going to go with 2, and obviously this is just for new people, right? So if you're somebody new to options, I would say the 2 best that you can go to would go with the credit spread and the calendar spread. Both of these because they're easier to understand and they're easier to adjust than some of the more risky and complicated and advanced strategies. So you can do a bullish or a bearish credit spread depending on if the stock is trending in one direction. The benefits here are you don't have to know which way the stock is actually moving, and you can be right even if you're wrong. The trade can still win even if you're wrong a little bit. The calendar can be done at the money when volatility is very low. If you want to adjust the calendar, you could wait until the stock hits the break even, and then you can either get out because it'll be a small loss, or you can reposition it at the money, or you could just exit the trade, or you could just add a second calendar. So it's not that difficult once you understand it. They're really simple to manage. Okay, so we have a question on the last one. It says that if options expire worthless, how do you make money? Well, the simple question, the answer to that would be that you would be the one selling the options instead of the one buying the options. So options are, if you're buying options, you're really kind of placing a bet. You're hoping that the stock makes a move in one direction or another. You're hoping that the stock you have to really know, okay, first you have to be right on direction, then you have to be right on the time, and then you have to be right on when, the amount of the move. So, if you are saying that I think, the particular stock is going to go up, that's great. You're 1 out of 3. Then you have to know by when is it going to move. Is it going to move next month? Is it going to move in 3 months, 6 months? You have to buy that particular option with the time left, and then you have to know how much it's going to move. Because if you think an option a stock is trading at say $100, you think it's going to go to $200, and you buy that $200 option, but it never gets to 200, but it did move, and it moved in your time frame, you're still going to lose out. So you have to be right on all 3. That's why I particularly love to sell options instead. Like I said, this is all my experience. I have tried my best to be an option buyer because you can online you can see the ads all over the place that you can turn $100 into $1,000, and you can turn $1,000 into $100,000, and that's how you do it with buying options. For example, if there's a stock that's trading at $10 and you buy some options and the stock goes up through the moon, well, you can make thousands and thousands of percent. It happens very rarely, and like we already discussed, there's a research out there that shows that most options expire, and so it doesn't happen. So that's why I prefer to be an option seller instead of an option buyer. What options, let's move on to the next one. What options besides, I think that's a pun. What options besides buying a call or a put can I do inside an IRA? So what trades can I do besides buying a put or call can I do in IRA? You can have almost the same options as you would in a regular account. You can even do naked puts and naked calls if you have enough money in your account. You can do credit spreads, you can do iron condors, you can do calendar spreads, you can do covered calls, you can do just about anything as long as your broker will let you. So a lot of people email and say, hey, I can't sell options in my account because I have an IRA. And what they're saying is that their broker is not letting them. That is a broker issue. That's not an issue with the trade or the strategy. It can be done. You just need to find a more accommodating broker, a better broker. Cool. In your blogs, you talked about with options trading, it really does not matter if the market goes up or down, you can make money. Can you explain that in detail? All right. So there are different type of strategies and different trades that work in different scenarios. So for example, there's an iron condor, and basically an iron condor is you are putting a box around a particular stock. As long as the stock trades up and down inside that box, the trade is going to make money. So if you sell options far out of the money, you want the stock to just sit there and not move very much. Even if it moves up or down a little bit, the trade will still profit if it stays within that range, within that box. Or you can do half of a condor, which is also known as a credit spread, and you could play it directionally. So right now, the markets they've been going up and up for years. The NASDAQ, the S&P, they're all at all-time highs. So if you think that that is going to continue, if you think that the markets are going to continue to go up, then what you can do is you can sell put spreads. And in that situation, if the market continues to go up, like let's say NASDAQ will for example, the QQQs, okay, you sell some puts on QQQ. If the NASDAQ continues to move up, your puts will expire and you'll make money. If the QQQ stops going up and just gets lazy and just goes up and down a little bit every day, your puts will still expire and you'll make money. Or if it goes down a little bit against you, as long as it stays away from your short strike, you can still make money. Okay, so there are trades that you can do for up markets, down markets, high volatility markets, and low volatility markets. So knowing the different strategies and how you adjust your trade allows you to trade just about any other market. Now, I do have friends that trade, one strategy no matter what's going on. I do have people that, I have friends that trade iron condors, and they are very, very advanced traders. They've been doing this for years. They make a living doing it. They make a very nice living doing it. One guy is actually, he has a lake house on Lake Tahoe, where he's retired with his wife. And basically all he does every month is he will put on this massive iron condor trade. And then based on what the markets are doing, he will adjust it by watching his Greeks. So if his deltas are too high, then he will adjust it one way. If the deltas go down, he will adjust it another way. If his data is too low, he will sell more options. So by the end of the month, it doesn't look like an iron condor anymore, because he's got iron condors, he's got credit spreads, he's got calendars in there. It's all mixed up. It's all one jumbled big trade. But as long as he is data positive every day, he knows that his trade is making money. So that's when you get to that advanced level, it's not about what strategy am I using or what am I doing. It's all about, having more theta coming in every day, having your deltas in a respectable range that you can manage them. Okay, what is the minimum capital one needs in order to sell options? Well, you can start off with like $100 or less, right? But the commissions are going to eat you up. So if you find an ETF that has 1 point wide spreads, you can do a spread and it'll cost you $100. But I suggest that you start with a minimum of $5,000, and $10,000 is good if you're going to start with my service. But before you do anything, if you're just starting out, paper trade, get the hang of it. Do a whole bunch of trades. Do them over and over again. Take your time, learn how they work. The markets are not going anywhere, so you don't need to be in a rush to learn. When do you know if the premium is overpriced or underpriced? Obviously, this is the price of the option. How do you know if it's overpriced or underpriced? Well, there are different pricing models out there. The name is on the tip of my tongue. Something Scholes is one of the most popular ones. And it's, they won a Nobel Prize. These guys are mathematicians. They won a Nobel Prize for figuring out how to come up with and calculate the value of what an option should be priced at. But in the real world, all those pricing models and everything, overpriced, underpriced, it doesn't really matter, because it's a market. So whatever the sellers and the buyers can agree to, that's what the price is going to be. You know, unless you're trading literally thousands of options, it doesn't really matter if an option is overpriced or underpriced by a few cents. Obviously, if it gets overpriced by a lot, the market makers will know it, and they will come in and they will change it up. So there's not really a really big arbitrage opportunity here. And if you're thinking that, hey, you know what, I'm going to go searching, I'll have my computer search for options that are overpriced, you know, they're just overloaded with premium, and I'll sell those and I'll wait for the premium to come in, that's not really a good way to do it. Because if they are overpriced, there is a reason they're overpriced. It's probably something that's happening in the company. The volatility in that company, the implied volatility in that stock is probably a little higher than normal. And there's probably some news that's happening under, probably nobody knows about it, or maybe just the company folks know about it, and there's some insider trading going on, or something of that effect. You know, something that very few people know about, and maybe that's why it's overpriced. So, you know, this particular, you don't need to worry about the models. You don't need to worry about overpriced, underpriced. If you find something that you want to trade, you trade it based on the probabilities, based on the trade and the risk reward. Question came in, what are the general commissions? Commissions vary by broker. So I have different trading accounts myself. In one account, I know I pay 50 cents per option. In another account, I pay $1.25 an option. There are brokers that will charge you a fee, and then like, let's say $3 per trade, and then maybe 15 cents an option or 20 cents an option. So depending on how many you trade, you would go with, you know, whatever option commission schedule you want to go with. But if the more you trade and the more money you have in your account, the more you can negotiate with these brokers. Nothing is set in stone. All these options, prices, and commissions, everything is set in stone. And so you should not be afraid to call them up and say, hey, I want a better deal. Otherwise, I'm going to take my money to some other broker that is going to give me a better deal. And a lot of people, and this is not on the slides, but since we're talking about brokers here, a lot of the people, for some reason, they have this loyalty to their broker. And I don't really understand it, because the broker's job is just to fill your orders, and they charge you for that, and they make money on the interest of having your money in their account. So they're making money off you. That's the only reason they're even letting you trade. But I have so many people that email and say, oh, you know, I'm with my broker and he won't let me, and I want to stick with this one broker. I mean, that's just, you know, it's your comfort zone. I get it. You understand how their software works, but you should not let your broker dictate what you can do with your money. Okay? That's just the way it is. You know, these guys are working for us. You know, we should be able to tell them, hey, I want to do this and this with my money, and if you're not going to help me out, then there's, you know, 50 other brokers in line that I could talk to. You're not the only game in town. And so if you have a little hard line with them, and if you don't have that feeling of loyalty, it'll be better off. Because having a bad broker is like trading with one hand behind your back. I've said that many times. It's really true. You know, having a broker that works with you, having a broker that's giving you the right service, the right tools, and the right prices is priceless. So another question came in. What broker is the 50 cents per option? So a lot of these brokers, when they're first starting out, when they're new, they'll give you a really great deal and they'll grandfather you in. The broker that is giving me 50 cents is it used to be called Trade Monster when they were new, and then they got bought out by Options House, and now Options House has been bought out by E-Trade. So eventually I'll be having an E-Trade account, but originally it was a Trade Monster account when they just wanted new accounts, and they were giving that 50% or that 50 cent per option you know, teaser rate. But luckily it wasn't a teaser. They kept it in there. Hopefully Options Express, or sorry, Options House kept me at the same rate. Hopefully E-Trade will keep me at the same rate as well. Next. With the present market condition, is it better to be a buyer or a seller of options? Now this obviously, depending on what time you're watching this, it could be a good market or a bad market depending on what you're thinking, but I would say that it's always better to be a seller of options. There are too many things that can go wrong when buying options that most people lose most of the time. About 80 to 90% of options traders lose money. Most of those people are buying options, and even when you start trading and selling options, you're still going to lose money because it takes a while to get the hang of it. It takes a while to get your emotions under control and stick to the rules and the trading plan that you have came up with. Or even if you don't have one, then it'll take a while for you to create one. And so, I would think that it's easier to be a seller. It gives you a greater probability of profit. It gives you a margin of safety. So why would you trade with the odds against you? That's what I'm thinking. Now, I get it that we all want to make quick money and fast money, and so anybody that is a trader usually has a little bit of gambler in them, and I do as well. And so what I do is maybe every couple months or so I will buy a option of a stock. I'll buy a call of a stock that I think is going to go up a lot, or maybe there's earnings coming up and I think, hey, this one particular company has been killing it, so I'll buy a call of theirs, and if I win, I win. If I lose, I'm out a couple $100, but that is enough to keep my gambler at bay, where I can control him so that he doesn't mess with my other, emotionally he doesn't mess with my other trades. So that's just something that I have found helps me keep focused on, I need to be selling, because like even now, the market's been going up for a while. You would think, yeah, let's just take all this money and buy a whole bunch of calls, right? Market's going to keep going up. Well, the odds are against you, even if the market's been going up. So why do that? Why not play the safe way? All right. How are European options different from American options? Okay, now this is a little bit complicated. There's a pretty long answer here. The one difference that I am concerned about is that European options cannot be exercised before expiration. American options can. Now there are some other differences, and of course you can go do a Google search and read up on those. It's a very dry subject and not something that I want to get into. So if you have trouble sleeping tonight, go Google search this one and read up on it. But the main thing is European options cannot be exercised before expiration, meaning you cannot be assigned. And so that's one of the reasons I would trade my iron condors on European options, and European options are normally the index options, so SPX, RUT, MDX. These are very large, very liquid traded vehicles that all have options, and American options are any stock on the stock exchanges, on the American stock exchanges, and ETFs. So even there's just that one thing I don't have to worry about. So even if a trade does go into the money or if it's close to the money, I don't have to worry about getting assigned. Is it true that on Monday after expiration the premium is cheap? Okay, so no. Option premium is cheap when volatility is low. I have not seen anything to indicate that it's cheaper on a regular basis on the Monday after expiration. Now normally what happens is that when your stock is going into expiration, the implied volatility of the stock will be high, and so yes, the option premium will be elevated. As soon as earnings come out, it'll go down. So the options will be cheaper at the end of the day than at the beginning of the day, most likely, because volatility is being sucked out. I have not seen that to be the same effect with expiration. And if you want to see the implied volatility of a particular stock. They all have it. So you take the implied volatility of the options, compare it to the historical volatility, and that's how you determine if right now, is the volatility of the stock high or low. And if it is high, you need to know why before you trade those options, because there's something occurring. There's some news event that's happening or coming out soon. You should be aware of that before you get into it. Okay, we have another question coming in on the side from Eileen. When can I acquire somebody else's stock? Is it a long call? What is the trade where I end up with stock? So Eileen, that would be a short put. Basically, if you have a stock that's trading at, say, $50 and you sell the 45 put, okay, you'll get a credit, you'll get money for that 45 put, and then if the stock does go down at expiration, and let's say at expiration it ends up at 45, you could be assigned that stock, and so you would have to buy 100 shares of stock at your strike price, which is $45. So you'd be buying 100 shares per option contract, and you'd be paying $45 each. Now, some people call this, buying at a discount. So if you are thinking of, hey, I want to buy this particular company's stock, but I don't want to pay what it is trading at right now, you could sell some naked puts. If the stock comes back down and you get the stock, that's great. If the stock keeps going up, then your options will expire worthless. You keep the credit, and then you could do it again the next month or the next expiration. And so that way, you can keep getting money a little bit, and then when it actually comes down to a price that you like, then you can buy it. All right. When is the best time to use a spread versus a straight call or put? Well, the answer is when you want to protect yourself or lower the amount in the trade. So if you're doing a spread, if you're doing a credit spread, for example, you're limiting your risk. If you're doing a debit spread, we're actually paying for the trade. It'll lower the amount of risk that you have in the trade as well, because you'll pay for the long call, and then you'll sell a short call, so you'll get some money so that you have less money in the trade. Now, obviously, your profit will be capped because of it, so there's offsetting its pros and cons. All right. In general, is it better to use stocks or indexes for spread trading? Now, both of these have their pros and cons. Stocks move around more. They have more of what's called beta and have news and earnings risk. I like indexes for iron condors, and I like stocks and ETFs for butterflies and calendars. So, an index is the S&P 500, the Russell, the NASDAQ, the Dow Jones. You can trade the ETFs of those as well. You don't have to trade the actual index, which is like SPX and RUT. You could trade SPY and IWM for those, but those are still indexes. And then you could trade stuff like Apple or IBM with butterflies and calendars. That's what I mean by stocks. And stocks move around. They're a little bit more volatile. They can move on news. So if something happens with the company, if they have some bad news, or if they have every quarter they have earnings announcements. So if they do good on earnings, the stock jumps up. If they have bad, it goes down, up and down. So based on that. Indexes, like the S&P 500, it's made of 500 stocks. So one stock does something crazy, it's not going to affect the index that much. All right, Leighton is asking, how do you know if an option is European? So the indexes, the large ones, SPX, RUT, those are all indexes. Those are European. Most stocks that we trade in America are American options, and then ETFs are all also American. And if you have any doubt, you can type in, you can look it up on the Chicago Board of Options Exchange website to see if it's classified as European or American. Gene wants to know, can you explain what the spiders are? The spiders are basically, those are SPY is the main one. Now, spiders is just a brand name for ETFs. So there's more than one, they have different ones, but SPY is the big one. And that's the one, it's an ETF for the S&P 500 index. So if you want to trade the S&P 500, you can do it in many ways, but the SPY is one way you could trade it as an ETF. SPX is the way you would trade it if you were doing the index itself. And then oil options. Oil options are futures options. All futures options are European, so they don't get exercised early. All right. As a novice options investor, should I just trade credit spreads or venture into iron condors or both? We kind of touched on this a little bit, but I would say here that the condor is a little bit harder to learn, but it can earn you more return for the same amount of margin or the same amount of money at risk. Now, once you understand how the credit spread works, I would say that you can venture into the world of condors. Until then, you start with one trade, whether you start with the credit spread, whether you start with the covered call, the naked put, something simple. Learn all you can and practice it until you can do that in your sleep. Once you get good at it, then I would say, you move on to another more advanced strategy. So the iron condors, ratio spreads, butterflies, all the different types of butterflies, iron butterflies, broken wing butterflies, calendars. Calendars are a little bit simpler, but then you have double and triple calendars, diagonal spreads. These are all very advanced strategies. And so those are ones that you would probably want to leave off. So you start with something simple. You start with it, you do it, you do it, you do it. For example, I'll give you a story. Simon Curio, he was a member of Option Genius, and he did a lot of the different strategies, and he came back and he told me, hey, Alan, this credit spread is the one I like. It's the one that fits to my personality, and so I'm going to focus on this one, and I'm really going to master it. So that's basically all he trades. It is a very simple trade, but he doesn't have to be very complicated in order to make money. I like to keep things simple when I'm trading, and so I don't use a lot of the technical indicators out there. I don't use a lot of the chart patterns and Fibonacci's and Elliott waves and all that. You don't really need all that. It just confuses you more and more and more. The more simple you keep your trading, the easier it is once you find a good trading plan. And you can either find one online or buy one from a course or whatever, or you can create your own based on your own personality, based on your own trading method, based on your own style. How much time do you want to be in front of the computer and what kind of adjustments do you want to do, or maybe no adjustments. All those things you take into account and you make your own, and then you just trade it and you practice it. And you do back testing on it, you do paper trading on it until you really hone it down. And then that's really how you become a successful trader. I've been selling puts or calls, covered of course. How can I find options where I get the most premium as a credit? Do you wait for a rising stock to pull back and then sell a put because it's approaching the sold put strike where it's more valuable? Or exactly how do you find options to sell? I think that is the big question. How do you find options to sell? Now, I might not have answered him exactly correctly, but so we don't do naked puts in the Option Genius portfolio. I do trade nakeds in my personal accounts. I choose, and how I do it would be I would choose a stock that I would like to own for years. And I trade around it. So basically, I buy a few shares, I sell some calls on those shares, and then I sell naked puts on those shares as well. And then I trade around the position. So if the stock goes up, I sell a few shares, or I let my shares get called away. If the stock goes down, I'll buy some more, or I'll let my puts get exercised. And then, I'm looking for something that's a good, stable company that's been around for years. Most likely it pays a nice dividend, or at least a small dividend. And then that way I have, if the stock goes up, I'm making money. That's one way. The dividend is giving me money another way. The puts are giving me money. The calls are giving me money. So I have 4 ways to earn income from one asset. I do not go looking for high premium options to sell. What I really believe is that you need to know the stock that you are trading. Okay, so what I do is I have a watch list. I have a set number of companies, and I watch them, and I look at their charts, and I watch the news. If I see a news story for one of them, I'll read it. I'll know what's going on in these companies. I have about I don't know, somewhere around 100 stocks or so that I'm watching. These are the ones that I want to keep adding to my portfolios. These are the ones that I want to trade my options in. I don't trade stuff like biotech. Yeah, the option premiums on biotech stocks are really, really high, but I mean, those things could go to the moon or go to bankrupt tomorrow. You never know, and I don't want to be holding the bag. Sometimes there are stocks that are like very low money stocks. They're not exactly penny stocks, but they're really cheap. For example, there's a stock right now called Dry Ships. It's selling for, last time I checked, it was like 75 cents, but it goes up, like 50 cents in a day, then it goes down at, 50 cents. So it's moving a lot. Percentage-wise, it's moving a lot, and you can sell and trade options on it, but I don't want that kind of volatility. And so I want to know the stocks that I'm trading. I want to know how they behave, because if I'm trading a stock and if I'm trading on options in the stock and all of a sudden it starts doing things that I don't think it should be doing, I mean, after a while, you're watching it for a while, if you're watching it for a few months, a couple of years, you kind of get a sixth sense of which way the stock is going to move based on the news that comes out, based on what's going on. Should it move with the market? Should it move against the market? And then if it starts acting in a way that is not the way it's supposed to act, you know that there's something wrong with it, and you not trade it, and that keeps you out of risk. If every month you just go looking for the stocks to sell the most options on, or they have the most premium, they could go against you, and you'll never know why. So that's not a good way to find it. Okay. How practical is the idea of trading as a full-time income for a retail trader, and what amount of capital would it likely require? Okay, we get this question a lot. There's I could go on and on, but I mean, there are thousands and thousands of people who do trade for a living. There are many, many different ways that people make a living trading. Some people do day trading, some people do swing trading, some people do Forex, some people do futures, some people do options, some people are stock traders and they make money. The amount you need depends on the style of trading that you do. So, I know more about option selling than the others, so I can tell you that option selling, the returns can be really, really good. 1,000%, or sorry, not 1,000, but 100% a year is not uncommon in a really good year. But I think that if you can live off a 30% return, I think you can move to full-time. I think 30% is a really good target. If you can live off 30%, then you have, you can figure out, say, okay, how much do I need? I need, maybe, a few $1,000s to survive. All right. So if I have a trading account of this X, and I get 30% of that, needs to be whatever my monthly income is or my yearly income. Based on that, those numbers, you can play around with it. I think I think you should be able to get 30%. We get emails from people saying, hey, I need to make 25% a month. And I'm like, no, you're crazy. That's not possible. There's no way you can do that on a month-to-month basis without blowing up your account. You're taking too much risk. 30% a year is very positive and very doable with options. Okay. All right. So that is the end of section 1. And before we go on to section 2, we've only been here for an hour, so I think we're just going to do 2 sections tonight. We'll get into the next section, but before we get into the next section, I do have a special offer only for you guys that are on here, the people watching this training. There's this training like this one and several other trainings we have are in the Option Genius membership. And so as a member, what we do give you are 3 to 5 option selling trades per month. These could be condors, credit spreads, butterflies, etc. These are both carefully hand-picked by me with an ROI of over 10% each for the month. These are very high probability trades, and they are carefully monitored by me and the staff, and then we adjust them when needed. We have a lot more educational content in the members area, and we keep adding more stuff, just like this training. And you get access to me, so you can get your trades looked at. So if you're in a particular situation, you have a question about a trade, you can ask me about it. And if you have any other questions, you can always email me, and I will get back to you. All right. We do offer several other free bonuses that will make you a better trader. I think I mentioned the paper trading workbook, which I think is awesome. That's in the members area. It's a free bonus. And for a limited time, we are going to give you your first month of membership for just $7. Normally we charge $79. So after your first month, it'll be $79. You can get it at optiongenius.com/trial. So optiongenius.com/trial. I hope to see you as a member. Ang is asking, can you provide your track record, please? We get asked for the track record a lot. We were asked by a few big companies, Google, the SEC, they asked us not to share our track record. So it's not something that we don't have it on our site, and it's not something that's not there because we're trying to hide it. If you join, you can see the track record since all the way back in when we started at 2009. And I would love to show my track record because we have years there where we were up over 100%. We have losing years as well. But they asked us after this, this financial crisis, they really contacted us and said, hey, you know what, your claims are a little bit unbelievable, because we were saying that, hey, we can make 10% a month, which, as all of you guys know, if you're doing a condor or spreads or something, 10% a month is doable. But they were concerned that people who are not familiar with this might get suckered, and so they said, we don't want you to actually show your performance. So so we took it down. Until then, we did have it. What I can tell you is that since we've started, I do the trades with real money in my account. So I'm actually in the trades every month with my real money, and since we started, we've averaged over 5% a month gains. 5% a month. But if you want the whole thing, then you can go into the thing. Nina's asking if we have a trading room. No, we don't have a trading room because we are not, we're not like day traders. So we're not in there all the time saying, oh, hey, Apple just went up, go buy it and make, 20 cents on it, and then we get out. And we don't do a lot of getting in, getting out, getting in, getting out. My thing is we want to put on trade, and then we just want to sit and watch, put our feet up, relax, go get an iced tea or something, and not worry about it. And by getting an iced tea, I mean, not just today, but I just want, I want that sucker to expire. I don't want to deal with it. I don't want to have to mess with it. I don't want to adjust it. I don't do anything. I want to put the trade on and then just let it expire and have the money go into my account, and I don't have to worry about it. No exiting or anything. That would be the perfect month. You put trades on and they expire and you're done. Cool. I made my 10% a month. That would be that's my goal every month. So no, we don't have a trading room, but that's why if you have questions, you can always email me. If the trade is going bad, then we will adjust it, and we email everybody as well. Okay, so let's go ahead and move on. Let me grab a sip of water, and then we move on to the next section. Anybody else have any beginner type questions? Let me see. If we have any questions that I missed. Okay, so Ang has some questions about oil. Yes, I am trading oil options. We trade the monthly oil options. Take 5% a month. Is that possible with most of the people who trade options? Yeah, 5%, $5,000 is a good amount to start with. Obviously, if you're brand new to it, I want you to be paper trading, right? Um, how do you make 5 to 10,000 a month trading options? Well, like I said, you want to, you want to aim for 30%. Right? So if you can make 30% a year, how much do you need? If you need $10,000, you can make 10% is 30% of what number? That's how big your trading account needs to be. No, sorry, that's wrong because that's a monthly number. So if you need, 10,000, that means you need to make 120,000 from trading profits. So 120,000 is 30% of what number? That's how big your trading account needs to be. Now, it will not actually need to be that large, and we can go on and on about this, but once your trading account is over, let's say $100,000 or $125,000, you can get what is called portfolio margin, and then all of the margin requirements on all of these, like these spreads, the butterflies, the naked puts, and everything, it goes down considerably, and so you would make a higher return. So you would actually need less money than in a normal, what's called a Reg T trading account. So if you're trying to make 30%, you would need less money in your account with a portfolio margin account versus a regular Reg T account. All right. Okay, Daniel has a very nice long question here. I saw a long-term backtest around 10 years on covered calls where one holds SPY and sells calls against it every month. The returns were almost identical to simply buying and holding the SPY, although the drawdowns were less. This seems to show that mechanically selling options offers little absolute returns. How do you reconcile this with your claim that selling options is profitable? It looks like timing is needed to gain a profit. Okay, so yes, it was a long question and you put a lot in there, but without more information, I cannot tell you or give you a right answer because I don't know what years it was over. I mean, it's 10 years, that's a long time. So hopefully this person knew what they were doing, but what was the trading plan itself? What options were they selling? Were they selling deep in the money? Were they selling at the money? Were they selling out of the money? Um, you know, if that's the sense, depending what you really want, and because you're in a sense here, what you're saying is that covered calls on SPY versus SPY just buy and hold. Okay, that's you're comparing those two, which is fine. But selling options is not just covered calls on SPY. Covered calls or selling options could also be selling put spreads in Apple or selling call spreads in Facebook. It could be something totally different. We didn't take a look at covered calls in SPY versus SPY buy and hold versus iron condors in SPY versus butterflies in SPY versus anything else in SPY. So depending on the trading plan and how this person traded it, can give you an answer. So I cannot say that the study shows that options offer no little return. Now, if you're saying that in this particular study, the drawdowns were less, and if you already took out commissions, well, then that's kind of a good thing if the drawdowns are less, because you're not losing less money, but it's easier for you to do it emotionally. Now, what I do in my retirement accounts is I have long stock. I think we talked about this. I have long stock. I do covered calls on those stocks, and I do naked puts or covered puts, or sorry, covered puts. And on the covered calls, sometimes I wish I hadn't sold the call because the stock keeps going up and up, and I have to, I would have made more money if I had just kept the stock and not done the call. So there are ways to do it. there's many different ways that can give you a different result. So without more information, I really couldn't tell you what happened or why it's like that. Oh, sorry, there was more here. So I think, so Daniel's saying that I think it was near the money every month. Okay, and he's asking, where does the edge of the option seller come from? Well, different strategies will give you a different edge, right? So covered calls is one thing. If you're selling in the money, you're not really getting much of an edge. It's really about, hey, I want the income from the covered call. You know, if I'm doing a covered call at the money on SPY, I'm going to try to make 2% every month or so. You know, let's say that's one example. I'm gonna do a covered call. I'm gonna try to make 2%. Now, I don't care what SPY does. SPY could be up 5% for the month. It could be down. It could be, you know, it could be up 20% for the month. I don't care. I am looking for my 2% this month. And then I'm going to do it again next month, and then I'm going to do it again next month, and then I'm going to do it in next month. And so at the end of the year, I should have 24%. Now, will SPY beat 24%? Maybe, you know, chances are it won't. But if I get my 2% like clockwork every month, then I have 24%. Now, in that case, if you're selling at the money, then you pretty much you want to be called. You know, you want your stock called away so that you get the money and then you move on to the next month. Okay, one more question and then we'll move on to the next section. In a credit spread, can you leg out from the long strike to take a profit and then leg out of the short strike as the stock drifts down, or does that become a naked call dangerous? Yeah, you got it right. You can do that if you have enough money in your account. You can definitely do that. I would not do that. If you got, you know, if your credit spread is making money, I would just get out of the whole trade. I wouldn't try to leg out like that, just because, like you said, you'd be naked. You'd have a naked call position, so it would take a lot more margin. The risk reward then doesn't make it worthwhile. All right. So let's move on to the next section. All right, asked and answered, the top questions asked by students. This section is called How Options Work, or in other words, we're going to be talking about the Greeks. Here is our disclaimer. Trading involves substantial risk. We are not financial planners. You know, we're not giving you any kind of advice, and don't trade with money you can't afford to lose. All right. So first question here, I owned some puts and thought they would increase in value when the stock went down. Right, that's normally how puts work when you buy puts. The stock has gone down a little bit almost every day for a week now, but my put has gone down too in value. Why? Okay, simple, but could be a perplexing answer, and the answer is theta. You are a victim of theta decay. So every day that goes by, your options lose value. The rate of decline increases the closer that you get to expiration day. So it's like exponential increase. That is why it is so hard to make money buying options. You have to be right on the direction. That's the first part. You have to be right on the amount of the move, how many points is the stock going to move, and you have to be right on the time frame. You have to be right on all three. So in this case, this guy was right on two of them, but it looks like he was wrong on the timing, and so his put is losing value every day, and it will probably expire before the move that he wanted to capitalize on is going to happen. So in this case, what could he have done? Well, maybe he could have bought a longer dated put that had a lot more time to it, or he could have bought a shorter dated put that was closer to the money. You know, maybe at the money, or maybe even in the money, and he would have made some money that way. So, I mean, with options, there are so many different ways you could do it, right? You could do in the money, at the money, out of the money. It's everything that you tweak can give you a different outcome. Is it possible to predict the range an index or an equity will be trading in the last 30 days of an option cycle in order to determine the safest entry point for selling option spreads? All right, this is a really important question here. So is it possible to predict what a stock is going to do? It is possible, and then it depends on how likely it is. So the answer here is you would do this by finding the standard deviation of this particular thing that you're trading. You can find out the formula for that online, or you can use your broker's trading platform. They probably have this functionality. So this is what I use to determine how wide I want my trades to be. Now, this is where statistics come into play, and if you're using a broker that has like any kind of analyze screen, they'll be able to tell you percentage-wise, how much this thing is going to move. And you could also look at the average true range. That's a good way to do it as well. And standard deviation will take that into account. They'll also take the volatility into account. They'll also take a few other options into account, like how many days to expiration and all that stuff. So normally, if you're doing a if you look at the statistics, right, and bear with me here. We're going back to college statistics class. You can say with a 1 standard deviation, you can predict that a stock will be in a 1 standard deviation range with a 67, I think it's a 67% confidence interval. If you go out to 2 standard deviations, you can be, I think it's 97% confident that the stock is going to stay in that range of 2 standard deviations. And then if you go out to 3 standard deviations, you can be 99% confident that the stock will stay in the range of 3 standard deviations. So if you want, you can go to your broker's platform, figure out what is 1 standard deviation, that's 67% chance. You go out 2 standard deviations, you got a 97% chance, and then 3 standard deviations would be putting you so far out of the money that you wouldn't get any credit for it. So that's how you would use the statistics to find this answer. Your broker's platform should have a way to figure it out for you. You just need to, if you don't know it, if your broker doesn't have any videos or something on their website, just give them a call and say, hey, how do I figure this out? And they should show you. If they don't have that functionality and you like that particular broker because of the rates or whatever that they offer you, just open an account at another broker that has the functionality. Ameritrade does it, Thinkorswim does it, all these other interactive brokers, they all have this kind of stuff, the big ones at least. You can have multiple accounts. You don't even need to fund them in most cases. Or if you do, you put a few $100 in there, and that way you get to use their analytics tools for free. Can you provide any light on time decay and at what periods it really begins to ramp up? Thoughts I have. When is it too late to put on a position? So let's assume I want a minimum of 5% reward at 85% probability. Generally, how close to expiration can I place the trade and meet these requirements? Is there a general rule of thumb? So it depends on the underlying that you are trading. Now, common wisdom is that theta decay kicks up the hardest in the last 30 days before expiration. So it goes up exponentially. It gets faster and faster as you get closer to expiration. So what I would do is I would probably look for a trade with your criteria starting at around 35 days to expiration. So depending on what the strategy is and what you're trading. So if you're doing a credit spread on a particular stock, a very liquid stock like Apple, you can go out 35 days and figure out I want a 5% return and I want to be at 85% probability of profit. So basically, a rule of thumb that I can give you is if you're looking at 85% probability of profit, you want to sell the option with a 15 delta. okay, 15 delta will give you a 85% probability of profit. So that's just a rule of thumb. It's not the exact number, but it's close enough. So basically what you do is 35 days to expiration, you go into your software, you pull up Apple or whatever you're trading, you look at the option that has a 15 delta, either the put or the call, doesn't matter, and then you see, hey, can I get a 5% ROI in 35 days? And if you can, well, then that's the trade you want. If you can't, well, then you'll have to either go for a lower reward, ROI, or you might have to have less of a probability. But most likely the time it's doable. Okay, I've heard the guys on CNBC's Option Action Program, amongst others, talk about options pricing in a 4% move or a 7% move in the price of a certain stock, for example, ahead of earnings. How are they coming up with this information? Okay, so this is a great question as well. You know, a lot of times they'll tell you, oh yeah, you know, Facebook might move up 4% or down % on earnings. They come up with this by looking at the price of a strangle. Now that's the cost of buying both a put and a call, both of them at the money. You divide that by the stock price and you have a percentage that Wall Street thinks the stock may move. Now it doesn't, you know, it's just a prediction. It doesn't mean that the stock will move that much. It could move a lot more, it could move a lot less, but that's, if you look at, you know, the prices of the puts and calls, it really takes into account what people are thinking. You know, if a lot of people are buying puts, then the put prices will increase. A lot of people buying calls, the call prices will increase. And the more those prices increase, the more the stock could move up and down because there's a lot more interest in it as well. How can I tell when entering a put or call spread whether the trade will be profitable for me if the underlying stock moves in the direction I want it to be? In other words, how do I know that the option I am selling won't outpace the one I'm buying, since if that happens, I'd lose money on the trade? Do I look at delta, gamma, vega, all three? Okay, so it seems like this person does not understand how a credit spread works. I will assume that you are selling credit spreads here. Because as he's selling a spread, you can look at the theta for the spread. If the theta is positive, the trade will make money. If the theta is negative, you are losing money. So both options will expire on the same day, of course, if they have to be for the same month. So you just make sure that the short option is out of the money. So when you do a credit spread, when you sell a credit spread, you get a credit. You get a certain amount of money. If you are getting a credit and your theta is positive, and both options expire out of the money, then you get to keep the entire credit. If you do a credit spread and you don't get a credit, but it says debit instead, that means you screwed up, and you need to relook at the whole trade, because that's not a credit spread, that's a debit spread. Which of the Greeks, if any, are most important for all investors to know about, and why? Okay, so there are a few Greeks that they talk about. There's delta, gamma, theta, vega, and there's also rho. Rho has to do with interest rates, which we haven't had to deal with the last several years. To really understand an option trade, you should understand delta, gamma, theta, and vega. Theta you should know because, you know, hey, if theta is positive, an option seller is making money. Delta you should know because it tells you how much money your trade is losing or making in every day, how much you could. And then vega and gamma will affect delta and theta. You don't need to know those as much, but as you get more and more advanced, then you need to know how the gamma can affect your delta, how the vega can affect your theta on a daily basis, so that you can kind of predict what is going to happen to your trade in the future. Okay, so delta will tell you, hey, what's going on right now. Gamma can tell you, hey, if the stock moves up tomorrow, what's going to happen to your delta, and then that'll tell you what's going to happen to your trade. So those are more advanced strategies. Once you become a more advanced trader, you should focus on those. In the beginning, you focus on delta, the main one, and then you can work on the other ones. Is there a good rule of thumb to follow for what the delta and theta should be when selling out of the money options as part of an options income strategy? No, not really. You want the delta to be as close to zero as possible, and you want the theta to be as high as possible. Obviously, if you're selling, you want theta high. If you're doing a delta neutral trade, then you want delta to be close to zero. You know, like a butterfly, condor, calendar, you would like the delta to be zero. So that way, even if the stock moves up or down, your position is not affected very much. All right, and that is the end of section 2. And again, we have this very special offer for you guys. Join the Option Genius advisory for just $7 for your first month. And you can do that at optiongenius.com/trial. I hope you'll join us. We take all this stuff that we're learning and we take it to the next level. We ask you to do real trades. And when we're doing the trades, if you have questions about them, you can obviously email and you'll get me directly answering your questions. So you don't have to just wait around for one of these sessions. You can actually ask her every day. And I try to answer every question every day if I can, or at least the next day. Sometimes I backed up, but I will get to every question. All right. Leighton is asking, is placing a conditional order to buy back a naked put the same as using a put spread? No, not necessarily. You know, it's the same idea basically, but the put spread will require less margin. So you're not naked. That's one thing. And then it'll also protect you in case of if the stock gaps against you, or if it moves against you and you're not at the computer, or if the conditional order for some reason doesn't go off. Did you place a conditional limit order? Did you place a market order? If you have the spread on, you don't need to worry about limit orders, market orders getting triggered. Even you can stay in the trade and you know what it is. So you know what your risk is. You can sleep at night probably better than if you just had some naked put options out there, and it would require less money as well. Another question. So volatility is high the week of earnings. Therefore, try to put on credit spreads for following week, or the following week does not get affected by previous week's volatility. Yes. So, well, okay. So when I'm doing credit spreads, I will not put on a trade until earnings is done. So after earnings, just in case there is a big surprise one way or the other. You want to not be trading during earnings. That's one way that you can get hurt you can't even control it. So it doesn't matter what the volatility is. I would wait until earnings is over, and then I would put the trade on. Okay. So the conditional order, Leighton saying, has to be at the market. All right. Well, yeah. So I mean, it's still the same. You'd still be more money at risk, or more money required for the trade, and it could obviously it would have to be at the market, but it could get triggered when you don't want it to be. I mean, we've had fat finger stuff going on in the past, and so you could try it if you're doing paper trading. You might want to try and see which one works best for you. I would probably stick with just doing the put spread if you're going to do it. If you're worried about the kind of credit, you're not getting enough credit, then you could actually make the spread wider. So instead of doing, let's say, a 5-point spread, you can make it 10, 15 points. So you still have a spread. Your risk is still contained, but you can still sleep better. Okay, folks, so that's it. We'll have to schedule another time to go over section number 3 because it's already been an hour and a half. If you have any questions, please go ahead and put them in now because I am losing my voice. And please go ahead and put them in now so we can take care of those. I can stay on as long as you need for that. But section 3 we'll have to do at another time. I'm sorry about that. We've already gone over. But I hope that this was very beneficial, and I hope you guys learned something. And I hope that it does make you a better trader or get a better understanding of some things. Um, you're getting it from the horse's mouth. You're getting it from somebody who's been doing this for 10 years and who talks to professional traders, all the time. So I've taken what I have as my knowledge and my experience and just put it up there for you. Do you have content for all the different techniques, calendars, butterflies, etc.? Yes, in the membership, Option Genius membership, yes, we do. We have different videos up there. We have different items that you could read on all the different strategies, most of the different strategies. We don't have every single one. There's a zillion of them out there. And we're continuing to add new stuff. We are going to be doing these live trainings for questions about iron condors, butterflies, covered calls, and I think there was one more strategy that we're doing. So I will email you. I'll email everyone and let you know when those trainings are. We do have an entire course for iron condors. It's not that expensive. But the Iron Condor course, goes through I think it's like 15 hours of talking about iron condors and adjustments, and we give 3 different trading plans that we've back tested. So, if you don't have your own trading plan of how to do the iron condor, you can just pick one of the 3 that fits your style, and then just go with that, and then tweak it as you go along. All right, one more question. Will the trades only be on Facebook that we have to look out for? No, ma'am. Option Genius trades are not put on Facebook. Those are only the oil option trades that are on that Facebook group. That Facebook group that you're talking about, Linda, is only for the blank check group, and those are the oil options that are only put on there. The Option Genius trades are put on the Option Genius website, so you can log into the site. We also email all the trades and all the adjustments to all members, and we also have a way that you can get text messages for free as well. So if there's a trade or adjustment, you can get a text and say, hey, we just put on a new trade, or hey, we adjusted this one. So you can check your email and get the details for that. Okay, Leighton's asking, I sell naked puts on stocks I would be okay owning. Why should I sell puts on stocks I own already? Well, that's a good question, Leighton. I'm sure you can figure it out. You're a smart guy. I remember the name, so I know that we've emailed back and forth in the past. So really, like I said, you want to have as many different revenue streams from your stocks as well as you can have. And what you can do is, let's say you have 300 shares of a particular stock, and you sell, oh man, we cover this in the synthetic annuity product. I forgot how it works exactly. But you can sell a certain number of puts. I mean, you could sell 3 puts, for example, right? You have 300 shares. You sell 3 puts. You get the premium for that. These puts would be a little bit out of the money, and so if the stock drops, right? If the stock, sorry, Robert, I think that's my voice. I don't think the sound's going out. Hold on, let me grab a sip of water. Okay, can you hear me now, Robert? Hopefully that's better. Okay, so let's say you own 300 shares of stock, okay? And you sell 3 puts that are a little bit out of the money. So you're making money from those, right? You get the credit, and hopefully those expire worthless because you want the stock to go up. But what if the stock goes down instead? Now, if the stock goes down, then you would be you could be perhaps forced to buy another 300 shares. Maybe you don't have the money. If you don't have the money, let's say this, that your short strike is, say, at $50. The stock goes down to $50 and it looks like it's going to continue to go down. Well, then the simple thing you could do is you could sell the stock, right? So you get out of the stock at $50. You're short puts at $50. And if you get exercised, well, then you get the stock back at $50. So you're not really out anything except maybe a commission. If that's the case, and you keep the premium from the puts. So, I trade around my positions, and so, if I have, like, let's say 300 shares of a particular stock or 500 shares, and I want to add some more, then I will not buy those, but I'll be selling puts along the way to just make extra money. Because the thing is that if I own the stock, I am watching the stock. Right? I'm watching the chart. I'm watching the news. I'm looking at the earnings. I know what's going on. So that would be the stock that I know a lot about versus another stock that I don't watch as closely. So I would be more likely to do well when I'm selling puts on a stock that I'm watching than versus a stock that I'm not watching, if that makes sense. So I'm already owned the shares, right? I'm already trying to get the dividend. I'm doing some calls on it, and I'm going to do some puts on it because I'm trading it around. I'm trading around the position. Okay. All right. Anybody else? Last call, folks. I hope I don't get a sore throat. All right. I think either you guys can't hear me or nobody has a question. So I am going to say farewell and good night. Before I do that, can you, if you guys thought this was helpful, can you go ahead and put something in the chat box? Just let me know. Maybe I can feel good about myself before I go to sleep tonight. That it was worth it. So let me know if and if there's something I could have done better, then we're having more of these trainings. So let me know, and we can improve it for the next one. And so if you have any other information or any other questions, you can still forward them to us, and I'll try to put them in the proper category, and we'll do it on the proper training. No, I was going to ask if you guys would rather have this during the day, but obviously you guys are here at night, so you could make it. I don't know the timings yet on the other ones. We might try the next one during the day just to see, but we will send the, I did record this one, and so I will put the recording up for a few days. Not for that long, but it'll be up for a few days, and then the recordings will be shifted into the Option Genius members area. So if you are an Option Genius member, you can watch these over and over again. If you are going to become a Option Genius member from our trial, optiongenius.com/trial, it's only $7 for the first month. If you become a member, then you can watch all of the replays in there as well. So cool. Yeah, several of you guys are saying that this is absolutely helpful and that you're thanking, and you're so that's awesome. I'm glad to be of service. And if there's anything else I can do, please feel free to reach out and send me an email. Until the next training, good night and happy trading.